Hello, welcome everybody. Thank you for being here with us today. We are broadcasting live from outside of Park City, Utah, where I am, and John is in Westchester or Greenwich or Connecticut.
Bronxville, yeah, Westchester, Bronxville, New York.
Bronxville. So we're super glad to have John back again. I can say from popular demand, let's just say that. So we're welcoming him back and talk more about Focus Growth, and we're looking forward to do that. As you all know, we can't see or hear you, but you are most welcome, and we encourage you to post your questions at the chat box or the Q&A as they come to mind, and please do that so we can get to as many as possible. We have lots of folks joining us today. We're going to be posting this on the Family Office Insights YouTube channel. Post webinar, a couple of days it'll take to put up there. And then if you're watching this and you feel others that you know could benefit from learning what you learned today, you're welcome to put them in direct contact with John and his folks. Send them to the YouTube recording, whatever works for you, but you feel free to do that. You don't need to check in with us. So with that, thank you all for being here. John, take it away. Thank you.
All right. So first, I want to thank Arthur and Family Office Insights for hosting us. And thanks to all of you for joining us today. As Arthur said, I'm John Lykouretzos, the CEO of Focus Growth. I have 15 or 20 minutes of prepared introductory remarks, and then I'd be happy to dive in and answer questions. And I think people should feel free to submit questions, and Arthur's really good at interrupting and kind of asking the questions so we can get them answered. So first, I'd like to start with just the three primary takeaways. First, the cannabis market is huge. It's growing rapidly, but it's non-institutional and it's incredibly complex. There are enormous opportunities for excess returns, but the market is very risky. So you need a high degree of skill to be able to navigate. Second, I believe Focus Growth is a curated team of professional investors with significant experience in private and public debt and equity, combined with hands-on experience starting and operating multi-state cannabis operations. The team is the largest investor in Focus Growth funds with over $30 million committed. And then third, our fund FGCP2 is an advantage structure that allows maximum flexibility in deploying capital to be the partner of choice for cannabis businesses and to generate the best risk-adjusted returns. Fund 1 has exited 3 investments with a gross IRR of 46%, and the fund has a yield to maturity of 17.3 and 25% yield to first call. And FGCP2, which we're raising now, we've raised $90 million and already deployed 50. The yield to maturity is 17.1 and the yield to first call is 26%. So those are 3 things I want to make sure you take away from this presentation. But now we can jump in just a little bit about the team, and I think this is a significant competitive advantage. My background, I started my career at Goldman Sachs doing banking and in private equity. That was 95 to 98. Then I started a long career in long short equity, first working at Tiger Management for Julian Robertson, then going to a fund called Viking pre-launch, where I was an analyst and portfolio manager. And in 2003, I left Viking and started Hoplite Capital Management. I launched Hoplite back in 2003, July 1st of 03, with $88 million. Continued growing that to a peak of just under $4 billion in 2014. In 2019, we had shrunk to about $800 million. The fund was up 10%, and I made the decision to return capital and start looking for other areas to invest in. I came into cannabis from my partners, Dave Feuerstein and Brian Meltzer. Dave and I are college friends, so we've known each other for 30 years. Dave was a litigator and started a New York-based cannabis-focused law firm back in 2016. His firm was growing and had grown to 12 people. They ran out, they're outgrowing their offices. As I was winding down Hoplite, I said, hey, why don't you and your team move in, be my tenants, and teach me about cannabis? So they moved in September 2019. My office quickly became a hub of cannabis activity, companies coming in. Yeah, by that, I don't mean cannabis consumption. I mean cannabis companies coming in and looking for advice, corporate advice, application services, and of course, capital. I was sitting in on meetings. I started to learn about cannabis, and I was really attracted to the market. I left the long short equity business, which is the most liquid, transparent, competitive markets in the world. And I thought cannabis was the other end of the spectrum: opaque, institutional, Byzantine legal and regulatory structure, a lot of risk, but providing a lot of opportunity. I approached Dave and Brian and told them my intentions to put together an asset management firm that focused on the cannabis space. But I felt strongly that I wanted operators as part of this team. And I asked Dave to start introducing me to operators in the space that he respected. In November of 19, he introduced me to my partners, Peter Bile and Jonathan Goldrath. And it was kind of a match made in heaven, so to speak. Pete is my vintage, had a career first in M&A and restructuring in the early 2000s, and then spent 14 years at various credit hedge funds, running CLOs, trader, risk manager, and credit underwriter. Jonathan spent 10 years at Fortress, working in New York through the GFC, going to London for the European crisis in 2011, and then joining Pete at a fund called Wingspan. When Wingspan shut down, Pete and Jonathan partnered and put in an application for a license in Pennsylvania in the first round of commercial grow process licenses. They were awarded a license in August of 2017. They moved to rural Pennsylvania near the Poconos and built a 60,000 foot greenhouse and a commercial grow processor. They were awarded a license to process in Ohio. So Jonathan moved to Ohio to build that. They were awarded a dispensary license in Pennsylvania's second round, and they got that operation up and running. And then when things were really frothy in the cannabis market, late 18, early 19, they decided to sell their assets. They more than tripled their money in about 2.5 years. For those of you familiar with the cannabis market, it imploded in 2019, and they returned to their roots as credit investors. And they acted as lead investor, underwriter, agent, and syndicator on 3 loans totaling $55 million. Each of those loans has been successfully repaid. I met Pete and John in November of 2019 and convinced them to pool our capital, our talents, and our efforts and start FocusGrowth. And the pitch was, we can bring a lot more than capital to the companies. Companies will want to partner with us because we bring not only capital, credibility, operating expertise. We can help the companies institutionalize and maximize shareholder value. And eventually, when more institutional investors and larger family offices begin looking at the cannabis space, I think we can build an institution that'll prove worthy of their capital. As I said, I'd ran Hoplite for 16 years. I'd earned A ratings from all the consulting firms, Monticello and Cambridge and Alborn and Axia. Was privileged enough to manage money for the state of Maryland, University of Virginia, Notre Dame, Bowdoin, and several sovereign wealth funds. So I knew we would do things the right way in an institutional platform and be attractive to those investors as they seek to deploy capital. Since then, we've built a team, and we're still hiring, building out more people on the investment side, as well as investor relations and finance, accounting, and operational functions.
So John, would you mind an editorial here?
Sure.
The other thing that I think that the people that you invest in, the companies you invest in, that you brought to the table is assurance to close, right? Because a lot of funny business was going around. People would say they had capital, they got excited about it, and then they couldn't bring the capital to the table.
Yeah, Arthur, look, that's a great point. And something I had observed when I was diligencing the space in late 2019, I actually looked at investing in other funds first. And I didn't think there was anything, kind of worthy of my family's capital, so to speak, anything of institutional caliber. And one of the things that I observed, there's a lot of brokers in the space. So people who would go to companies, promise them the world, they would take a 6 or 7% capital raising fee. They promised the companies very uneconomic terms. And then, the companies had placed all their eggs in that one basket. As the brokers went to try to raise the funds, the deals weren't good enough to attract funds, and we saw a lot of opportunities from busted deals. So yeah, one of the things lacking in the cannabis industry even today is credibility, and credibility to close is a big thing. So we have never signed a term sheet once we sign a term sheet, we'll go through the process later. Apologize for that. I'm working at home and the doorbell, but once we sign a term sheet and we embark on confirmatory due diligence and final documentation, we have never failed to close.
Yeah, it's a big, people don't realize often that if it's okay to get paid to raise capital, I'm not trying to be derogatory about that, but if the friction is so much, no one's going to invest in it, right?
Right. Look, I agree. And just, part of my training on the buy side was always looking at the principal risk. It's one thing when you invest in a fund or a company, if the people are acting as agent and all they have is upside, that's one thing, right? That's the carrot.
Right.
But the stick is equally important, especially in terms of managing money. And as I said, FocusGrowth and our team are our biggest investor with over $30 million committed to Fund 1 and Fund 2. So we act as principal. We certainly have a stick. If we make bad investments, it's not only our reputations, but our capital on the line. And then, of course, we have a carrot. As a fund grows and continues to succeed, we share in the economics on the upside.
Yeah.
Perfect. But I think that's a very important point. Thanks for asking the question and raising it.
You bet. Thank you.
So just going back to like a bit of a timeline, as I said, the team, we met in November of 19. We started working together almost immediately, started drafting our documents. COVID hit, so we weren't raising a fund. We did a couple of deals pre-COVID. They were $10 million, and I funded them in an SPV with the intention of shifting them into the funded cost. We had our first close in August of 2020. That first close was $53 million, 20 million of that was internal capital. We had subsequent closes and continued to build a portfolio and fund companies. We had our final close in April of 2020. In September of April of 21. In September of 21, we issued our final capital call. Fund 1 has been deployed. We started distributing capital. We made a distribution of 17.5% of capital committed in January of 22. We made our second distribution in April of 2022 at 4.5% of capital committed. And the plan is to make quarterly distributions of at least 3%. The distributions will be augmented by amortization of some of our loans and principal repayment. We also launched Fund 2, FGCP2, in September. And as I mentioned, we had 2 closes so far, bringing total committed capital to $90 million, and we've already deployed $50 million. So I'll get to the fund terms later, but we have a 2-year investment period. It took us just under 2 years to put Fund 1 to work, and once we're invested, we'll start making those distributions. Just an overview of investments, and I'll make this a little bigger so folks can see. The typical investments have an interest rate somewhere in the mid double digits, an OID, which stands for original issue discount, somewhere between 5 and 10%. And what this means, an OID of 10%, for example, if we make a loan for $11.1 million, but it's issued with a 10-point discount, that means we fund the company $10 million. And the company pays interest, whatever the stated rate of interest is, on the full face amount. So in this case, $11 million, 11.1 face amount, company would pay interest on that face amount. When they repay the loan, they have to pay the face amount. And again, a typical loan has an interest rate in the mid double digits, OID in 5 to 10%. Loan duration are 3 to 4 years. And what this column over here means is the call protection. So if we do a 4-year loan, as was the case here, private company F, it'll be non-call 1. So the loan isn't callable in the first year. It's callable at 105% of the face value in year 2, 103% in year 3, and par in year 4. You'll see some of the loans have non-call 2. We typically allow the loan to be called at par during the final year of maturity. These combined, the OID and the call protection, are ways to increase the yield to maturity and the returns to investors. So if you think of something with a 10-point OID and 107 call in year 2, if this loan gets repaid in year 2, that OID gets amortized very quickly, along with the call protection premium. It augments the return of a stated interest rate of 13%. The other thing we use, or tool we use, is tranching the funding. So we may underwrite a company for a $15 million loan, and the first tranche that we release might be $5 or $7 million. And then the subsequent tranches are released subject to our discretion. So this is great for the company and for us. If you're borrowing and you have CapEx needs, but you don't need all the money day one, you don't want to take that money and start paying interest. So, this is beneficial to the company. And from our perspective, this lets us see another card, so to speak. If we're funding an acquisition, this lets us see how the acquisition is performing before we release the second or third tranche. If we're funding CapEx, we might put in milestones where first or second harvest need to be produced and tested before we release the second and third tranche of the loan. So I think it's beneficial for both parties. When we underwrite a loan and we release the first tranche, we take the entire collateral package. So the loan is multiple times covered and it's beneficial for the company. I want to walk through just one example here. This is private company A. So first, our capital goes in as growth capital. We don't fund greenfield. We like to see companies that have both assets and cash flow. And if push comes to shove, I'd rather have the cash flow as opposed to the assets. And the reason is we're looking for companies with an operating history where management has the ability to become institutional, to really create institutions and maximize value. Those are better credits for us. We don't do business with a lot of companies. We've done loans with 11 companies, and we think we're finding and helping create the winners in each of the states. So private company A is an example of something I'd like to walk through. This is the third loan. It's the most recent loan we've done for $100 million. Private company A was the first loan we did in March of 2020. And this was an Illinois company that had about 9,000 feet of indoor cultivation and 2 operating dispensaries. And in 2019, this company did 4.6 million of EBITDA. They came to us for $10 million funded. And the use of proceeds was to increase their indoor canopy from 10,000 square feet to 30,000 square feet and to open 2 new dispensaries for which they were already awarded the licenses. So we gave them the first loan, and that was a $10 million funded, $11.1 million face, so a 10-point OID. It had an interest rate of 15% and an 18-month maturity. So this loan was really rich. It was priced with a 24% yield to maturity. But again, think of the timing. This is March of 2020. COVID had just hit. There was a lot of uncertainty. Markets had seized up, but the company really wanted to embark on their growth plans. In 2020, cannabis in Illinois went from a medical market to a recreational market. So the company grew dramatically. They went from 4.6 million of EBITDA in 2019 to 23 million of EBITDA in 2020. The family that owns and runs the company used their equity to expand into the state of Michigan. And then we helped them diligence and source an acquisition in Arizona. So we took out our initial loan a year later at a 33% IRR and extended the company $58 million to close any acquisition in Arizona and to increase the flowering canopy in Illinois from 30,000 to 50,000 square feet and to invest in some of the CapEx in Arizona. The company ended up doing 34 million of EBITDA in 2021 and then came back to us with acquisitions in Ohio and Missouri. The company used their equity to fund these acquisitions and our debt to grow canopy and build out the state of Missouri. So this $100 million facility that we funded in February of this year took out our $58 million facility and is helping the company grow and close the acquisition. So the company's expanded from 4.6 million in one state, single state operator, to 34 million, going to near 50 million in 2022, and has grown from one state to 5 states. So we've really been de-risked here. We've grown with the company. We've provided a lot of value-added services in sourcing and diligencing acquisitions and helping the company think creatively about growth.
Maybe there's too many moving parts in that series of loans, but is it fair to say that you were firmly in first position along the way in most cases?
Yeah, I think that's a good question. We are the only debt. The tranches we've invested in are the only debt, and in almost all cases, we are the only lender. So in this case of $100 million debt, you can see we took 27 million in Fund 1. That was a rollover of our existing loan. We funded 20 million from Fund 2, and then we set up an SPV for our co-investors who are in Fund 1 and Fund 2 to round it out. We are the agent of record. We control the situation in all instances.
And the real estate is included.
Yeah. So one of the things I was going to say, in addition to the terms of the loan, interest rate, OID, et cetera, the collateral package here is really everything. So in these cases, since we are the only lender, we have a guarantee from the parent. We take mortgages on all the owned real estate. We file a perfected lien security interest, and all of the other tangible and intangible assets. And then we take an equity pledge from the subs that control the licenses. And last but not least, we have deposit account control agreements with the banks. We typically negotiate landlord waivers such that if we have to seize the assets, we can continue operating them until we either find a buyer or continue to run the assets. So the credit documents are really scary. And I think for, for first-time borrowers, they're hit with this and there's a little bit of a shock, but we walk them through. We never want to be a loan-to-own counterparty. Our goal is maximizing value and providing growth capital. And now that we have a portfolio of 11 companies, any new borrower, we encourage them to talk to our portfolio companies and find out what kind of partners we are. So we never want to do a loan. If we're sitting in an investment committee and the question is solvency, that's not a loan for us.
Yeah.
Oftentimes companies will come to us and they'll say, we need $14 million. We'll embark on diligence pre-term sheet and we'll say, Arthur, you don't need 14, you need 18, but your company can only support 12. So what we're going to do is we'd fund 12 and we'd fund dollar for dollar on equity you raise, right? Just to make sure the company's in a position to succeed. Sometimes what we've seen in the past is companies disagree with us. They've gone a different route. Someone has underwritten them and given them the money, and we're starting to see those loans come back to us because other lenders need to get bailed out. But we are growth capital. We're not looking to restructure. We're not looking to take people out of their existing problems. We are looking to find and anoint winners and grow with them.
Yeah. And in the case of company A, it could have gone off the rails in a number of ways, but it wouldn't be the collateral, it would have been growth and the licenses that.
Yeah, that's true. And when we underwrite, though, we are typically, typical loan is 2 to 3 times trailing EBITDA and, up to a 40% LTV going in. And as the companies grow, that LTV really comes down, as does debt to EBITDA or debt to free cash flow on a forward basis. So we're typically 2 to 3 times EBITDA trailing, less than 2.5 times forward. EBITDA is a poor proxy for cash flow just because of taxes in the cannabis industry. There's something that investors may be familiar with called 280E. It's a part of the IRS tax code, and it stems from the 1980s, when some of the folks on the webinar might remember Fortune and Forbes richest people. Some of those people were drug dealers. Like, drug dealers would pay taxes, but they would try to write off the cost of bribes. And the US government started 280E, which said you can only write off direct operating costs. So what that means for cannabis companies, if we're running a dispensary and our sales are $100, typically the markup is 100%. So our cost of goods sold is 50, our gross profit is $50. We have to pay federal taxes on that $50. We can't deduct rent, personnel costs, insurance, utilities, marketing.
Wow, you can't assign an expense of any kind to that.
Not for the federal government. State by state, some states, when they're assessing state income tax, adhere to the 280E. Others let you go all the way down to the pre-tax line and deduct expenses. So it really varies state by state. That's why I think people looking at EBITDA and only EBITDA could be making a big mistake, because when you're comparing, a state like Florida with California, and then different things in the food chain, the cultivators have much higher deductible expenses versus dispensaries. EBITDA is a very crude metric at best. And
so that's, we know what you're doing is federally illegal, but we still want our pound of flesh, and we're not going to let you deduct against it. I get it. Right?
Yeah. It's interesting, and I'm sure we'll talk about like regulation and the view for federal rescheduling and federal legalization, and we can get to that a little later. But one of the other things in terms of LTV, we use a multi-pronged approach. It's based on cash flows and it's absolute value, not looking at the public markets. We'll use pretty conservative multiples on conservative numbers, on our cash flow numbers. And our numbers tend to be significantly lower than management's base case forecast. And over time, I think our numbers prove more accurate. But the other thing we'll look at is real estate value, cash flow value, and license value. And license value varies state to state. For example, in non-limited license states, Oregon, Colorado, California, we may value the licenses next to nothing. But in a state like Illinois or a state like Florida or Ohio, Maryland, Missouri, things that are limited license, there are enough representative transactions over a 6 to 12-month period that we can really anchor to. And then we can also talk to our portfolio companies that are acquisitive and looking to grow and say, hey, how are you thinking about or looking at the value of a tier 1 license in Ohio? So sometimes licenses are significant value. 6 months ago, a vertical license in Florida traded for $55 million in cash just for the paper.
Wow.
Right. So, but we take all of that collateral in every case, but it's a very conservative approach.
Yeah. And in the case of Florida, we can move on. I'm sorry, but in the case of Florida, it was because the limited license granting.
Yep.
And
yeah. And Florida also has what's every market is different. So for example, in Illinois, you have a wholesale market. Like you can be a cultivator, I can own dispensaries, and I'll buy your product. In Florida, the licenses are vertical licenses, which mean you need to control all 3 parts of the process: cultivation, processing, and dispensing. But Florida's a super attractive state. It's a very populous state. It's an aging state. It's forecast to be almost $2 billion just in medical. When that state goes rec, it's going to be $4 to $5 billion. But the cost to entry is so high, as we said, the license is $55 million just for the paper. And if you invest in the paper, you're going to want to build it out. And scale is your friend. You can't grow cannabis outdoors in Florida. It's too hot. You can't really use a greenhouse because it's too hot and humid. So you need to build indoor cultivation. Indoor cultivation with cost inflation is $500 to $600 a square foot, and scale is your friend. So you're going to want to start with at least 20 or 30,000 square feet. That's 15 to 20 million bucks of capex just for cultivation. Since there's no wholesale market, you're also going to need processing. That's another 2 to 5 million. And since you have now processed product, you're going to need dispensaries. You're going to want 5 to 10 dispensaries. So someone who buys a license in Florida for 55 million bucks is probably looking to spend another 50 to 100 million dollars to optimize that license and position themselves to grow in the state. Every state is different.
Yeah, super interesting.
Huh. Yeah, it creates a lot of opportunities, and there's and different tiers of licenses. So in Illinois, for example, there's a tier 1 cultivation where there's only 21 licenses out there. You can go up to 210,000 square feet of canopy. Now they're issuing craft licenses, which when all said and done will only be 14,000 square feet. It's going to be tough for these craft grows to compete with a massive scale indoor facilities.
Because they still have to do their distribution and processing, right?
They don't, because they can sell into the wholesale market, but just on a cost per square foot or cost per pound basis.
Yeah.
Well, exactly, right? Because the difference might be $1,000 or $1,200 a pound in cost versus $600 or $700 a pound.
Yeah.
And then while we're on it, you can grow outdoor, you can grow in greenhouse in some states, and you can grow indoor. So Pete and John built a greenhouse in Pennsylvania. It really just depends on the climate, but outdoor is the lowest cost to grow, but it's the least controlled environment. So a lot of times the outdoor flower will get processed and sold into vape cartridges, tincture, topicals, or edibles. Greenhouse is a little bit of a blend. I mean, it's a temperamental plant, and you have things to deal with like powdery mildew and mold and other pest infestations, especially if you're not operating a sealed greenhouse. If you're opening the vents and letting the plants cool that way, it could be a lot cheaper. You don't have to invest in the same degree of chillers, but it's a less controlled environment, but it's somewhere in the middle. Growing indoor is the highest quality, almost pharmaceutical grade, where this flower, depending on the market, can attract a significant premium of 50 to 100% of regular wholesale pricing. So we advise our borrowers as well. We have good discussions with people about, hey, I have indoor cultivation in Maryland. I'm looking to build a greenhouse. I'm looking to do pods. I'm looking to do outdoor. What do you think? And we'll present them with a market analysis, and here's where we go based on a cost per to grow the capex, time to market, or to grow the cannabis, invest the capex, time to market, and then ultimately how we think it'll sell in the market.
Is there still a lot of wiggle room for mistakes? Because
a lot in greenhouse or indoor design. in cost. And right now we've just seen massive cost inflation. So as I've said, we haven't done any greenfield. And I think that's where some lenders have gotten into trouble. People come, they have a license, they've raised equity, they're going to break ground, and maybe they'll give them a loan that has 7 months of PIK, assuming that it's going to be 5 months of construction. Then you get your first harvest, you're generating revenues within 7 months. The truth is those loans have to get restructured because things are so much more costly, 50 to 100% inflation over original budgets, and they're delayed. And that's where we're seeing people come back to us with problems, and we're just not interested in helping others out.
Yeah. So it's same thing in many of the businesses with the supply chain delays
Yep.
and cost, right?
Yeah, you're seeing a lot of that. The other thing I'll say is we really make these companies institutional. So in addition to, showing someone a credit agreement where they have sticker shock, just looking at all the terms, we have pretty onerous ongoing reporting. So most of the companies we deal with, they're sophisticated operators. They're not sophisticated from a capital markets or financial perspective. So they can run good businesses. It's on QuickBooks. They don't have audited financials. They don't have data rooms. So a company comes to us, we like what we hear, we give them our due diligence questionnaire, we're helping them populate a data room, we're going through QuickBooks and bank account statements, we're recreating historical financials, we're bringing in Eisner Amper, which is, we use Cohn Resnick as the accountants for the fund, but Eisner Amper comes in and does quality of earnings assessments for us.
So like attestation type stuff?
Yeah, exactly, right? So we want to know, we've assessed, where there might be certain deficiencies, and we need to diligence them and make sure those deficiencies are created going forward. And then we have pretty onerous reporting. So the company on a monthly basis, we get bank statements directly from the bank, and then companies have to populate dashboards. So at this point, we have a tremendous amount of data and KPIs. We know what's selling, we know prices, we know locations, we know costs, we can benchmark, we can do a good analysis. It's valuable to new borrowers as well.
And so when they are in a position to be monetized because you put them in an institutional way, you're going to participate on your upside, plus make sure you get paid back.
Yeah, we get paid back. And, it's, I think companies, it's one of those things like, God, do we have to do this? Oh my God, I'm glad we're doing it, but it's a complete pain to do it. And we have monthly calls scheduled, but the truth is we talk to our companies weekly, sometimes many times a week. If they're engaged in a project or looking at acquisitions, they really value us. And this is why I'm happy to say when we're competing or looking at new issuers, when they talk to our portfolio companies, they learn the type of value we can really bring.
Yeah.
Yeah. So it's very interesting.
Yep. Thank you.
Yeah, sure. Thanks for the questions. Just kind of moving on here. As I started earlier, this market is really, really huge. And the way I think of it, from 30,000 feet is it's $100 billion market, plus or minus 80 to $100 billion. Only 25 billion of it is legal. Over time, all of that 100 billion and growing is going to migrate into the legal market. And this happens as more states come online with licensed medical products, medical markets, medical programs, I should say. What usually happens is a state will enact a medical program, something like 1% of the population get their medical cards. That grows 10, 20, 30, 40% month on month. A couple years later, you have 3 or 4% of the population having medical cards. There'll be a referendum or a ballot initiative. The state will vote on making recreational cannabis legal. Once that passes and gets enacted, pretty quickly, you have 10% of the population consuming cannabis, and that continues to grow such that in Colorado, it's an estimate that 20% of the population consume cannabis. And that's still a far cry from beer and alcohol, which the estimates are 60 to 65% of eligible people consume. So I really view this as a growth market. And I think as time progresses, some of the things driving the growth are not only states going from no program to medical program to recreational program, but a change in form factors and just a change in the educational levels. So while I might never want to smoke flower to smoke a joint, I might never want to vape, as we increase the way to consume cannabis into tincture, which you put under your tongue, chocolates, gummies, topicals, and beverages. Beverages are going to be a massive market. I think Americans are social. We don't want to go to a consumption lounge and maybe smoke joints or take edibles, but if we can sit, socialize, consume something that tastes good, that has 2.5 milligrams of THC, I think we're early days in this market. And just on that as well, we spoke earlier that there's 3 real stages. There's cultivation, there's processing, and then there's dispensaries. Cultivation is the most capital intensive. So it's also what I believe is like the most valuable, having a cultivation license, especially in a limited license state. We tend to finance things at all stages, but most of the stuff that we've been financing are vertically integrated or at least have cultivation. We have not invested in or financed brands. And I think it's early days for brands. As this market gets built out, at this point, brands don't really matter. It's accessibility and availability and shelf space. So brands are going to be interesting over time, but at this stage, we prefer to stick with the operationally intensive, asset heavy cultivation, processing, and dispensing. Just here's our investment process and the way things work. Today I did a call with a company that's looking to raise capital. It's a big company. They're looking to refinance and then take in some more money for M&A. So I take notes on the company. I send the information to my investment committee. When we have an investment committee meeting, we'll engage a subset of the team. We'll have a follow-up conversation with the company. We'll sign an NDA. We'll get into the data room. We'll start to socialize terms internally. We'll come to the investment committee and discuss a potential term sheet. We'll go to the company and we'll submit the term sheet. Once we have a signed term sheet, we get exclusivity. The company will also pay us a deposit, somewhere on the order of $50,000 to $200,000. So this covers the expenses as we begin our due diligence and start racking up legal fees. This is good because first, it shows the company is serious. Second, it protects our investors from dead deal expenses. We had virtually 0 dead deal expenses in Fund 1. We have the investment committee review, submit the term sheet. We go into final documentation and confirmatory due diligence. And then we get to the end of the process where we'll review the final findings at investment committee and we'll fund the acquisition, or we'll fund the loan or the investment. As I said earlier, we're not looking to do business with everyone. We're not a BDC. We're not a REIT. We don't have limitations on portfolio construction or concentration. Our hard caps are 15% of funds committed or $20 million, whichever one is greater. We tend to construct a portfolio with 10 to 15 positions. Fund 1 had 14 investments across 11 companies. I assume Fund 2 is going to be similar. We've told investors for Fund 1 that it would be, this was an indicative mix, senior secured debt, hybrid securities, and equity. In reality, Fund 1 was 97% senior secured with 3% in a hybrid. I think the same opportunity exists for Fund 2. As I said, the yield to maturity on Fund 1 is just over 17 with the yield to first call at 25. Fund 2 yield to maturity is 17.1 with the yield to first call at 26. I believe that Fund 1, our net returns will be in the high teens, and we're forecasting net returns for Fund 2 in the mid to high teens with at least a 12% cash return in the form of quarterly dividends at 3% once the fund is fully invested. And then, as I stated earlier, we're building an institutional product. So the investment terms, 2 years plus 1 with a 1-year extension. We invested Fund 1 within that 2-year period. I expect the same will be set for Fund 2. A harvest period of 4 years with a 1-year extension. Our loans are 3 or 4-year loans. We've done 1 5-year loan, but it's our expectation that loans will pay back before maturity. There's a 2% management fee on committed capital. Once the fund is invested, that steps down to 1.5% on invested capital. So as we return principal to our investors, the management fee will step down not only from 2 to 1.5%, but the dollar amount invested continues to go down. We have a 20% incentive fee with a 100% catch up that's European style. What that means is investors, if you invest $100, we'll call that $100 over the investment period, and then we'll start returning that money to you. You will get your money back an 8% annualized preferred return. After that, the manager will get paid their 100% catch up. That's basically 1.6%, 20% incentive fee on that 8% that you've already received. And then it's an 80-20 split going forward. The GP commitment, I believe firmly, and you have to eat your own cooking. And we've committed 3% of the fund or $10 million greater of. We've already invested 12 million. So depending on the final size of the fund at final close, that number could grow as well. We do allow co-investments. So for some of the larger deals, the last deal we did, it was $100 million. We offered co-investments to investors, giving priority to the largest investors first. Lowenstein Sadler's our fund counsel, and SS&C Technologies, which is the biggest fund administrator, is our admin, and we use Cohen Resnick as a fund auditor. So those are the prepared remarks I have, but I'd be happy to answer questions, or Arthur, if you think there's specific things which you want to dive deeper in, just please let me know.
So the status again in the raise, the total amount, target, and then you're 90 in, right?
Yep, we're 90 in, 50 is already out the door, and we'll cap Fund 2 at 400 million, because that's an amount I think we can put to work within 2 years. It's not really a target, it is a cap. We can't control ultimately what we raise, but we can cap it at 400 million.
Yeah, and when the last fund was how much?
The last fund was 163.
Right. Thanks, that was super helpful. This is a question that is related to sort of the status, insight you can give. A dispensary still relying on ATM and cash. Can you use credit cards at dispensaries, and what is the status and expectation of federal legalization? So if you have an hour, you can tell us all that.
Yeah, no, sure. I'll start with the answer to the question. Yes, most of the transactions dispensaries are cash. You cannot use a Visa or MasterCard today because they operate on the federal rails, and since it's federally legal, you can use debit. When you're there, because it's kind of the PIN based and it's on the ACH network. And it's interesting because there have been solutions to try to facilitate, credit card. And when you talk to a dispensary owner, they remain unconvinced that allowing the use of a credit card will increase their sales. And in the meantime, they have an ATM there, they're earning $3 or $4, fee
every time. Yeah.
So I think these makeshift solutions, they've largely failed. In terms of when will you be able to use credit card and the status of banking, there's Safe Banking Act, which has passed Congress 5 times and has never passed the Senate. It was widely expected this year that Schumer would lead it through the Senate, but Schumer kind of stepped away from that in April, said he'd reintroduce it before the summer recess. Nothing gets done before the summer recess. We have high inflation, we have a war in Russia, we have potential economic uncertainty. I don't think this is on anyone's radar. My best guess is that this will come back in Congress in the first quarter. If it passes, there's a 180-day comment period before it's enacted. Once it's enacted, safe banking uses the Graham-Dodd definition of banking, which does not include capital markets. So in terms of the impact of the loan market, we already see credit unions and state licensed thrifts in the business. They lend against the real estate, and those dollar amounts are so small. So for private company A, they had a cultivation license and a facility that they had invested over $10 million in. I think that license alone is worth 30 million. So this cultivation facility might have been worth 40 to 50 million in the eyes of a borrower. The bank gave them $2 million because they looked at this building and said the highest and best use outside of cannabis is $4 million. We're going to give you 50% LTV. So I don't think banks are going to be lending against cannabis cash flows or licenses anytime soon. I think if I was just a real estate lender or REIT focused fund, I might experience competition first. I think with our flexibility and creativity, we'll be pretty well insulated from that. And then lastly, on federal legalization, it seems easy to do, but even if things became federally legal today, I think it would be a number of years before the market was functioning similar to beer and alcohol. First, I think states will look to offend the Commerce Clause. If I'm the governor of Illinois, I don't want all the cannabis consumed in my state being grown in Arizona and California and Colorado and Oregon. I care about jobs and I care about tax dollars. So I think it's going to be a long time before you have a market that looks like beer and alcohol. I'd say that's probably 7 to 10 years away.
Yeah. And back to your comment about lending, if I'm a borrower and I put a bank in the first position against my assets using the building and everything else, then I'm blocked from getting debt on something else, and no one's going to be in the second position arguably anyway, right?
We've evolved from, so private company A, we made them pay back that mortgage. It was a 6% mortgage. It was $2 million. The collateral on private company A, the enterprise, probably worth $300 or $400 million today.
Yeah.
We would say, you know what, we'll take a second on that real estate. It doesn't matter. We have the license, we have all the equipment.
Yeah.
So I think our goal is what's best for the borrower. And we are really flexible. So there's been cases when, we did a deal in Oregon. It was a $25 million deal. They're continuing to acquire dispensaries, and they have a basket for which they can sell leaseback that real estate. But if they can get financing at 6 or 7%, we mandate that none of the capital leaves the system. They're not paying dividends. They're not changing salaries. Everything needs to be pre-approved. But if they can take that money where they're borrowing at 6%, invest in our business and collateral base, we'll let them do it. So I think it's just one example of we're sophisticated, and that gives us flexibility to be really great partners.
And the banking, let's just call it what it is, generally, especially when putting their camel's nose into this tent, are not sophisticated under the best circumstances, right? So
I think that's true. And, no offense to bankers out there, but banks don't want to lend money. When you talk even to, they'll lend against real estate and look at the highest and best use. But, for all of those on the webinar, if you have private equity funds and you talk to the funds and you ask them which banks they do business with, their answer is going to be banks don't want to lend money. I need 5 turns of EBITDA. I'm going to Ares. I'm going to HPS. I'm going to other credit, Golub. I'm not going to a Wells Fargo or Dime Bank.
No, it's not the banker's fault. It's the regulators, right? And right. So like, you want us to put that asset on your balance sheet and forget it, right? Yeah.
Yep.
So you see that?
I'm looking at the question, but what was your other question?
No, I was just going to ask you to look at that. Yeah.
So does the debt strategy of the fund change if there's scheduling and primary institutions can loan directly under these rates?
You kind of answered that, right?
Descheduling.
Yeah.
Look, we do see banks. There are some banks. East West Bancorp wants to be in this business. Valley National wants to be in this business. I think, and we're in touch with both of these banks, I think the opportunity is to partner with the banks. So if you look at private company A, we're in a driver's seat. We underwrite the whole loan. We're the agent of record. We're syndicating it. There's an opportunity for us to go to a bank and say, okay, there's $400 or $500 million of collateral the way we see it. However, there's physical real estate of $40 million. Do you want to take a real estate secured first out piece for 8%? 8% is a great yield for a bank. And that has the impact of leveraging the returns to our fund investors. So we've engaged in those discussions. I don't think it'll be too long before we start to see those discussions, before we start to see those materialize.
Totally makes sense. Then the other question before we run is, are you sourcing deal flow from operations that can handle scale?
Yes. Yeah. So 2 things on that, if I understand the question. First, some of our deals have come from existing operators. So if you operate in the state, and Arthur and I are both competitors in Ohio, but there's a lot of white space. I like Arthur. Arthur's looking for money. I'm going to say, Art, you should talk to the guys at FocusGrowth. We've had that exact case in Ohio. We've had that exact case in Missouri. And we do look for operators that can scale. It's either one of 2 things we'll look for: either private company A that has ambitions and the family capital to grow in different states. Like, that's super exciting for us because we take all the collateral and we can help them grow. If they put in the equity, we can help them invest in the CapEx to enter new states and grow their enterprise value, kind of buy down our LTV. Or the second is, hey, there might be a family in the state of Maryland. We love the state. This company's going to get gobbled up by private company A. That's going to be good for us as well.
Yeah, totally makes sense.
Yeah.
See that last one there? What is your opinion of interstate trade as it pertains to companies predicated on the vertical integration to avoid margin compression? Does it change your strategy?
Yeah, look, this is a really great question. I addressed it a little bit in terms of saying states would offend the Commerce Clause. I'd also say that our loans are 3 or 4 year loans. And I would say that the prospects of things happening within the 3 or 4 year loans where interstate commerce exists and maybe our collateral value is diminished because they're importing cannabis from other states. The crystal ball is pretty clear on a 3 or 4 year basis. If I was making a 10-year loan, I might have to answer that question and think about those risks differently. Making an equity investment, same thing. I'd have to think about that a little differently. But also say that, there's not enough capacity and there's not enough capital right now to finance the growth in states like California and Arizona to be able to supply the whole country with high quality indoor grown products. So if I'm investing in an indoor cultivator in Ohio or Illinois, I still think there'll be value even if and when interstate commerce exists. I think, there's a project out there, a company called Copper State in Arizona. They have 40 acres under glass, a 40-acre greenhouse. You have massive 500,000 square foot greenhouses being built in California. I don't think indoor grown cannabis in Maryland, Illinois, Ohio, Missouri. I don't think that outdoor grown cannabis in California, it's kind of like apples and oranges. So that's how I think about those risks. But it's a good question. And we've gotten that question a lot. Interstate commerce happens and suddenly your $40 million valuation of a facility in Ohio gets cut by 80%. I don't see it that way, and I certainly don't see it that way in the next 5 years.
Yeah, probably have lots of ramp up time and try to adjust along the way, right?
You do, and there's no capital. I mean, let's face it, the equity markets have been crushed. The equity markets for cannabis, crushed. Lending rates in cannabis have widened out, and these are for the biggest public companies. Cresco did a deal at 13% yield to maturity 2 years ago. They refinanced that 6 months ago at 8%, but those bonds are trading at 95.
Yeah, what's that tell you, right?
Things are widening a little bit, but these are for the public companies. If you're a private operator looking for equity or debt, odds are, especially for equity, you're just not going to raise any money.
Yeah. Wow.
It's a great time to be, I think, in our business.
Yeah. Very, very helpful. Well, thanks for doing this again, John. And let's keep track with you here. I'll make sure everybody's in touch with you directly. So you see all that stuff. We'll get everybody that you can talk about. And really, really appreciate it. And enjoy the weekend and your move. And we'll talk early next week.
Yeah, thank you. And Arthur, thanks for hosting. Thanks for the questions. Thanks for keeping it flowing. And everyone, thank you for spending your time for your questions. And as that Arthur was said in an email connecting us all, I'd be happy to engage one-on-one. And everyone have a lovely, safe, happy holiday weekend.
That's right. Thank you.
Thanks so much. Bye, everyone.
As I always say, thank you for spending with us the only thing you can't make more of, and that's your time. Thanks, John.
Thanks. Bye, everyone.